Hello YouTube. I hope that everyone is doing well. We are looking at STEP index on a daily time frame. I have been following this market for a while, and I know a lot of you guys trade a lot of markets. You're hopping from volatility pairs to jump index pairs to crash and boom, all of that nonsense. It is unnecessary. Focus on one market, focus on one trading session, focus on one trading model, and you will find success. If you notice the pattern that I drop these videos, it is specific. It is linked to the model that I trade in this indice. The reason why I trade this one specific market, which is STEP index, it is because I can wear different hats. I can day trade, I can swing trade, and I can scalp. I can do a lot in this market. I don't need to look at any other market. STEP index is the way for me. So today we are in episode 3 of the letters of a synthetic indices trader. Now in this YouTube series, I am talking about specific things in the marketplace that I find interesting. If you notice the pattern that I drop these videos, they are linked to my own specific model. If you look at the previous commentaries, you will notice that I drop something in the opening of each month. If I don't find anything interesting, then I will be in the mid-month. If I don't find anything intriguing in the mid-month, then you will find me around the 20th of that specific month. I follow that pattern because of my findings with this pair. I've been trading it for the last 5 years. So in this YouTube series, you will find that I have been dropping videos specifically linked to time. Whatever that I've been dropping, whatever that I've been talking about in this YouTube channel, it is specific. It is linked to time. And these are the little things that trigger me into opening a position. All right. So here is my daily journal entry. If you're not journaling your trades, journaling your activities in the marketplace, then you're going to have a hard time navigating through these markets. So today's topic is about order flow. Order flow, you hear a lot about that word in the ICT's community, and you don't understand what it is. Well, let me break it down for you. STEP index on a 1-minute time frame. Let us travel back to the 15th of November. This is the New York opening range, 7 o'clock to 7:30. You need to switch your time zone to New York, good people. So how did I utilize these daily key levels to formulate this short trade based off the 75% quadrant level on the November 15th? This is how I shorted the market utilizing the New York opening range of 7 o'clock. This is the model, good people. We are looking at specific key times of the day, and we are going to use that specific key time of the day based on the daily key levels. So here is the 75% quadrant level. It is very sensitive, okay? So here is the opening of that range from 7 o'clock to 7:30. Price opens and it goes up to take out the buy side liquidity. Immediately after that buy side liquidity is being taken, it displaces lower. It creates a market structure shift. And out of that market structure shift, we have inefficiencies. All of these inefficiencies can be used as a selling mechanism. But which one provides you with high probability shorting opportunity? If you look at the daily key levels, you're going to notice that the 75% daily quadrant level has this inefficiency. This is how I was able to pick this inefficiency. Yes, there are a lot of these inefficiencies, but there's only one that provides a good trading opportunity. Why did I pick this one as a shorting opportunity? Because this one is linked to the daily wick quadrant level, 75%. And I utilized time. I did not enter here. I entered around the 10 o'clock hour. What is the 10 o'clock hour? The 10 o'clock hour is the second round of news. Well, my guy, we are trading synthetic indices. News do not apply in synthetic indices. Yes, they don't apply. But because of the way synthetic indices are coded, they utilize specific key times of the day, just like the real world markets. The very same way that we have the 8:30, we know that the 8:30, it is the first round of the news releases. 8:30, we have the New York news release. In the real world markets, we have the NFP, the CPI, whatever. We have all of those news. But here in Deriv, we don't have the news, okay? But we use the very same mechanism to operate in the marketplace. So when is a suitable time for you to trade your daily key levels? We have the opening range, 7 o'clock to 7:30. You could have used this inefficiency to open your short position. But for me, I utilized the 10 o'clock hour. Why? Because 10 o'clock hour, we have the second round of the news. If you notice, in New York time, we have two times where the news are going to be released. It's two times. It is 8:30, the news embargo lift. We have NFP, CPI, GDP, whatever it is, those types of news are being released at 8:30 in New York local time. If you're trading currencies here in synthetic indices, those times of the day are also suitable for you to trade the markets. So we use timed based models. So here is the second round of the news. What is price action doing up here? It is retracing into a timed based model. 75%, what is that? It is the daily key level. It is coming back there when? 10 o'clock. And look at the reaction. It moves away rather quickly. Why does it move away that significantly? It is because it is linked to time. So if you were entering like I did in the 15th of November, utilizing this 1 minute fair value gap, I had a tight stop loss. I am not negating that you should use a tight stop loss. I am not promoting that. But because I'm utilizing lower time frames, I am going to use a tight stop loss. Right? So where is the draw on liquidity? Where is the liquidity that I could target? Well, I have the liquidity down here at the 50%. I have the liquidity at the 25%. Each of these key levels can be targeted. But the one that I used for my target was the daily wick low of the 12th of November. It had this low in London session. It had these lows as well in the London session as well, hugging the 25%. It had this low around the first hour of the news release. We had this particular low. All of these levels, they are linked to time. It is time-based liquidity. And these time-based liquidity, they are not random. They are hovering at the daily key levels. If the daily wick low, this is where the London low was printed. Another London low was printed at the 25%. Here comes the New York session. New York session low, here it is. It is hovering above the 25%. So these timed liquidity pools can be used as a form of a draw on liquidity. This is where I had my target, 80,040 at the daily wick low. Look at how it moved. It was quick. Why? Why was it quick? It is because it is linked to time, the 10 o'clock hour, second round of the news. This is what I was able to accomplish in the 15th of November. Let us scroll back to the current affairs of STEP Index. Look at this. It moved. Wow. Wow, man, it moved a lot. But anyway, let's go back to the current affairs of STEP Index. Let me unzoom a little bit, okay? All right, here is the current affairs. We have the 16th of November. We had the retracement back into our daily wick consequent enroachment. Shortly after our daily wick consequent enroachment was engaged, we had a consolidation between the daily wick consequent enroachment and the daily wick low. We had this gyration of price action between these daily key levels. Here is the New York opening range of the 17th of November. All right, price action used the 25% to go up. It used that particular level. Let us zoom in a little bit, right? So we have the consolidation. It is rather ugly, hence why I wait for these specific key times of the day. So here is our New York session, opening range 7 o'clock to 7:30. All right, what have we left down here at the daily wick low? We have left sell side liquidity. But for our model to work properly, price action needs to go in the opposing direction first. So what does it do? It goes up. Where? At the daily wick consequent enroachment. When does it do that? It does it on a schedule. Here is the 7 o'clock to 7:30. We have a fair value gap. It is bullish. Notice this inefficiency. It is hugging the 25% quadrant level. This is a high probability fair value gap. It is converging with the daily time frame, daily wick quadrant level, the 25%. What is the converging PD arrays based off the ICT concepts? Well, the converging PD arrays refers to where multiple price delivery arrays from different timeframes align or overlap at specific price levels. This convergence is considered a high probability signal for a potential market reaction. Here is the opening range. Here's a fair value gap. It is converging with the 25%. This is a high probability setup, but the fair value gap is bullish. It goes against our bearish bias. It supports on the fair value gap and the daily wick 25%. It uses this particular key level of the daily time frame as a support. These are support and resistance key levels, good people. It uses that particular level. It goes up to attack what? It attacks the consolidation. This is the buy side liquidity. It attacks that buy side liquidity. It is trading above the daily wick, consequent enroachment. These are the little mohawks on the daily time frame. Price action is allowed to go and trade above the daily wick, consequent enroachment. It is permissible, but the daily candlestick bodies, what are they doing? They are closing below the daily wick, consequent enroachment. What is that telling you based on order flow? It tells you that price action was going up in here to just take liquidity. What are other retail traders thinking when they see this consolidation breaking up here? They are seeing that particular level as a support, since it was used as a resistance, now broken above to be used as a support. It does not work like that, my guy. It does not work like that. We are only going up here to trigger all of those buy stops. Everybody is triggered in going long. Why are they thinking like that? Well, if you recall, we had the 16th of November going up. So when people see these highs being broken, they think that price action is going to continue in going up. Well, that is the problem. It's a huge problem, and I've fallen victim to this type of thinking as well. But the narrative is telling us that we are only going up here in the daily wick consequent enroachment to use it as a resistance. So these daily key levels can be used as support and resistance. So here is the opening range of today, the 17th of November. Our fair value gap being used as a support initially. We do not subscribe to a bullish bias. We have a bearish bias. Okay? So price action uses that as a support. It goes up, attacks the buy side liquidity, it drops down. All of these inefficiencies are not traded back to. That is a good sign. Price action has no willingness to rebalance these bearish inefficiencies. All of these are breakaway inefficiencies. Which inefficiency are we allowed to trade? Which inefficiency can be used for us to enter into the market, since we know that it is bearish, it is going into the downside to attack the liquidity? Well, this inefficiency, since it is linked to the daily wick 25% quadrant level, this is a converging PD array from the daily time frame, now linked to the 1 minute time frame. We wait. What do we wait for? We wait for the 10 o'clock hour. The 10 o'clock hour is the second round of the news, right? So here is 10 o'clock. Price does what? It goes lower. It bumps the daily wick 25%. It uses the wick 5% as what? As resistance, resistance, resistance. How many times did you guys have an opportunity to use the 1 minute time frame New York opening range as an inversion fair value gap? You had multiple setups after the second round of the news. We don't trade the news, guys. Step Index has no news, but we utilize this time. The way that we utilize it in the real world markets. Support and resistance. This is the real world market. That's how support and resistance ideas are utilized in the ICT community. Okay, so I've entered a short based off the 25% daily wick quadrant level. If I had a short here after 10 o'clock, where is the sell side liquidity? I just taught you timed based liquidity. Let's refer back to the 16th of November. Down here, we have the 10 a.m. sell side liquidity. This is the second round of news of the 16th of November. Look at it moving away. There is the sell side liquidity. Here is London session. These two levels, they are close to each other. That is suspect. London and New York session are close to each other in terms of the lows. This is sell side liquidity. This is where money is residing. Down here as well, it is the 16th of November's low. All of these key levels are converging with one another. If we pull out the session breaks, there's something that I want to show you guys real quick, okay? We open for the new trading day of the 16th of November right here, right? This vertical dotted line, it is telling you the opening price of the day. If we zoom in that particular day, we can see the opening price of the day. Here it is. This 16th of November's opening price, it has these lows, that low here. Here's the London low. Here is the New York low. All of these liquidity pools are timed based. They are near the opening of the 16th of November. This is timed based liquidity, good people. It is literally telling you where the liquidity resides. This is where price is going to go. This is where I've entered my short position, right here at the 25% quadrant level. So I know where the liquidity pools are. They are in close proximity with one another. Don't be surprised when price action trades below this particular low here.